Hello there, Maverick Traders. This is Imri, and welcome to this class on the characteristics of impulsive price action. This is such an important class right here. This is one of the core concepts of advanced chart reading that I use literally every single time I'm looking at a price chart. And the best part is that this concept is universally applicable. So although here, we're dealing primarily with currencies, fiat and crypto, if you do decide to venture out into other asset classes, this concept will serve you equally well. And on a personal note, that is a key feature of my own individual trading plan, is that whatever I have in my trading plan has to work equally well on every single market and every single asset class and every single time frame. So I believe that universality is a very important quality to be able to have, because it just expands the number of opportunities you're able to be looking at. So let's, let me just jump off my soapbox there and let's get right into it. So today we'll be taking a look specifically at impulsive price action, but there are in fact two types of price action. And categorically speaking, I will say, again, just my opinion, everyone's entitled to one, but in my opinion and in my experience, there are only two types of price action, which makes reading a price chart infinitely easier once you grasp this concept. Because from now on, whenever you look at a price chart, all I want you to think, or the first thing I want you to think is the market currently in an impulsive phase or in a corrective phase? Okay, so there are only two types of price action: impulsive price action, and then there is corrective price action. Impulsive price action is the kind of price action that leads to new higher highs in an uptrend or lower lows in a downtrend. It's defining the trend, all right? Impulsive price action defines the trend. So they're the kinds of price movements that all traders want to capture. When you look at a price chart, I'm talking about the big, strong moves that a lot of people seem to miss, and they're wondering, how on earth did I miss that? Well, hopefully after watching today's class, you're going to have a much better understanding of how you can be prepared for these big moves in the future. Now, on the other side of things, we have corrective price action. It's choppy, it's slow, it's sideways. And corrective price action, this is a key hallmark of corrective price action, is that it retraces a percentage of the prior impulsive wave. Now, a market is usually not trending. Most of the time it is in a corrective phase. And so therefore the odds are, when you're looking at a price chart, you're looking at corrective price action. And this is where a lot of traders fall into this trap, is they try to trade that corrective price action instead of zooming out a little bit and keeping in mind a bigger picture, which is that once corrective price action concludes, it will be followed by impulsive price action. So I see way too many traders attempting to trade corrective price action. And again, I'm really hoping that today's class is going to help you with this. Okay, so impulsive price action, what is it? Well, it's trend defining. Like I said, impulsive price action defines the direction of the trend. It's typically fast moving. So this type of price action usually moves quickly. We typically see very large bodied candles during the impulsive phase, especially relative to the corrective phase. And these are simply the best types of price action to trade because of how large the moves are, especially relative to past corrective price action. So you can see here on this price chart here, the blue arrows are denoting the impulsive phase of the market, whereas the orange arrows are highlighting the corrective phase of the market. Okay, so we can see here, this first blue arrow, the market's moving strongly. Look at those big green candles. There's very few red candles, and notice that the red candles that are there are typically very small bodies. And then we move into a corrective phase. Okay, so I mentioned this earlier, it bears repeating. Impulsive price action is followed by corrective price action. Corrective price action is followed by impulsive price action. That's why I say it's so important when you're looking at the market to understand which phase the market is currently in, because it can only be in one of those phases, one of two phases, impulsive or corrective. So you can see here in this first corrective phase, we have a mix of bullish and bearish candles, right? So it's showing basically a fight for control between bulls and bears, or as I like to say, between optimists and pessimists, but it's really the same thing. Notice how the price action here is choppy, it's sloppy, it's going sideways. This is typically where we see our bases, our high bases, our low bases, and so on. And then we get another short little impulsive phase. And you can see right away, these candles here are much bigger, right, than many of the candles we've seen during the corrective phase. And then the market digests that move. We go sideways once more in a corrective period. And then boom, we get a huge, beautiful move. This is what you want to be in the market for. The market's rallying here for several weeks. Strong bullish candles. Notice how most of these candles are closing near their highs. Then we get a brief corrective pullback followed by another impulsive phase. Now this is just basic chart reading 101. What happens as we move into this phase here? Well, we can start seeing something we haven't seen during the prior impulse phase. We're seeing a lot more indecision candles here. All right, so we've got 3 weeks of choppy trading during this impulsive phase. And notice here, these bearish candles are much larger than anything we've seen in the past. So that's a hint that perhaps the maturity of this trend, in terms of assessing the maturity of this trend, that the trend might be quite mature and there is potentially, a larger reversal in the works. Okay, not definitive. I'm just saying we can start inferring some information. All right, so moving on to a second example, and we're going to take a deep dive into the Kiwi Yen currency pair specifically here. Okay, so we're going to, again, I'm showing the two phases of the market, the blue arrows showing the impulsive phase and the orange arrows showing the corrective phase. And then we're going to do a much deeper dive, into Kiwi Yen, like I said. So this should be pretty straightforward after we just covered that first example on the dollar yen currency pair. But again, we see big moves with the blue arrows and then corrective price action with the orange arrows. So notice the corrective price action will always retrace a certain percentage, right? And that's why we look at Fibonacci retracement levels. It will retrace a certain percentage of the prior impulsive phase. Now let's add another layer on top of this price chart. Okay, so now I'm labeling the pivot points on this price chart here, and we've gone away with the arrows, okay? So I've got some black trend lines here that denote one of my favorite ways, all right, of trading corrective price action, right, which is using trend lines. And then, these trend lines form chart patterns, and those chart patterns have names, and there is only a finite number of chart patterns, which is, again, fantastic, because once you learn what these chart patterns are, then it makes your life a lot easier, because now it simply comes down to step 1, are we dealing with impulsive or corrective price action? Step 2, what is the chart pattern? Step 3, is there a viable reason to risk some capital and look for a trade? But the pivot points here are incredibly important. So I just want to focus on the left-hand side of the chart over here first. So we have a downtrend. We have a series of lower lows and lower highs, right? The definition of a downtrend. And bonus points if you can recognize the bearish impulsive price action and the counter trend bullish corrective price action in this downtrend. Okay, and then what happens? Well, we make a final lower low, and again, notice as we make that lower low, this is what I call an exhaustion, an exhaustive bottom, right? Notice the long wicks on these candlesticks here, okay? So yes, we do make a lower low, but by the end of that low, it's very clear that there is some buying pressure in the market. And you can see here, we make a lower high, but instead of making a new lower low, we break this lower high, and we do so impulsively. And then we trade sideways, and this is very important. We break this other lower high. All right, at that point, this is what I would call key support, key resistance. This lower high right here is critical resistance. If we take out key resistance, it means the downtrend is in jeopardy. We take out the second lower high, the second pivot point, that is critical resistance. And that's enough for me to say we're dealing with a reversal in trend. And keep in mind, guys, this is on a weekly chart, but like I said at the very beginning, all the concepts that I like to teach are applicable regardless of the market, regardless of the time frame. You will see this exact same behavior play itself out on a tick chart, on a daily chart, on a 1 hour chart. It doesn't matter. So Now notice how we start making higher highs, right? We have a higher high here, 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 and we have lower highs along the way as well. So now we're in an uptrend, but we're not done yet. We're gonna add one more layer on top of this same price chart. So take a look at this. Now we're getting into the potential trading phase, all right? And now this class is fairly high level. I'm not diving into the nitty gritty of how you can start applying technical studies like moving averages or Bollinger Bands or the ins and outs of chart patterns. I'm just showing you what's possible. And I'm hoping that you start seeing the matrix as it were, in a slightly different way. All right, so here we've got a combination of black trend lines, which, and I'm showing you what the chart patterns are. So we've got an ascending triangle, a bull flag, a falling wedge, and a symmetrical triangle. But we also see how the moving averages play a role here as well. So we can see in this ascending triangle here, prices found support on both the 20 and 50 period moving average. And then as we form this bull flag, we found support again on the 50 period moving average. And then we make a little impulsive pop here. Impulsive because we made a new higher high. We make a corrective pullback here. And notice how we find support, technical support. So although we broke below the 50 period moving average, we did not break the higher low. So the uptrend is intact, and then we get another strong move out. And right now, this looks like corrective price action to my eyes. All right, corrective price action because we're moving sideways. Bulls are still in control. This would be my key support, this swing low here around 80 yen, a little bit below 80 yen. And then this would be my critical support, a little bit below 76 yen in the cross. Okay, so if we break below critical support, that's when I would say, yes, we have a definitive shift in trend. And again, because this is a recent price chart, I just want you guys to keep in mind that this is a weekly time frame chart. Okay, so to recap everything, I want you guys to start doing some homework. And if you want to send me your homework assignments, you can. Practice identifying impulsive price action on a chart. You can send me the charts if you want. Email them to me. I'm more than happy to take a look and say, yep, you've got this concept down, or this is the one tweak that you have to make, and then you're going to be on the right path. So giving you guys a little bit of homework here. Practice identifying impulsive price action on your price charts. Feel free to send that homework to me. Okay, number 2, combine other technical studies to determine the maturity of the trend. All right, so what we've talked about so far is identifying impulsive price action. What we haven't talked about is how can you figure out, when that impulsive trend is going to come to an end. And again, you want to combine other technical studies, whether it's momentum indicators like relative strength index, or if you don't want to use indicators, you can simply look at prior historic resistance and support levels on the price chart, right? Multi-year swing highs, swing lows. The market does respect those levels, especially in currency markets where, we see a lot of range-bound action. And by range-bound, I'm saying, over several years, most of the major currency pairs are trading in a broad range. And then finally, number 3, you want to incorporate trading strategies that suit your individual needs as a trader. So for me, those are chart patterns. I stay away from things like moving averages. It's not that moving averages are good or bad. They're just tools. Bollinger Bands are simply a tool, right? And every tool is only as good as the job that you need to use that tool for. So for me, trend lines, that's perfect. Those are the tools that I rely on the most. Moving averages, they're just a tool that don't seem to work as well for me, just based on my individual personality and my individual needs as a trader. So keep that in mind always when looking to incorporate new stuff into your trading plan. So I hope this class was worth your time, and I'd love to continue this conversation. And next week, I'll be talking about the characteristics of corrective price action. So we're going to look at the other side of the coin. Thanks everyone for your time. Look forward to seeing you in the next video.